David Byck. I was first introduced to him, I want to say 2019 or something like that. And I had to fire like 3 or 4 different CPAs to get to him, and I haven't looked back. He's the only one that truly understands our profession, being real estate agents. And I would say that's not very common in the tax world, let's say. So, with that being said, he's helped me save thousands of dollars with different strategies that he'll go over, and I'll just say tens of thousands of dollars, right? And there's really like 2 things, and he'll cover this again, but 2 things. Like step one has got to be your, designation, your S corp or your LLC. He'll cover that right off the bat. He'll help you with that. And then number 2, tax, like saving money on your taxes starts with planning now, right? So
truth.
like he'll say, 2023 taxes, sorry if you're not signed up with him, it's kind of too late for that, but the best time to start is now. So without further ado, David, take it away.
Sean, thank you. I appreciate that. That was amazing.
Of course.
Thank you for having me. So as you may or may not know, you may have seen me at CEO Masterminds or other presentations. My team and I focus on real estate and real estate professionals like yourselves. The name of the company is called Reptax, which stands for Real Estate Professional Tax. So you have a pretty good idea of what our niche is. Florida is unique. I mean, every state's different. Florida is unique in the fact that it allows you guys to choose your business structure, which means you could not choose anything, meaning you're paying a 1099 directly to your individual name. You can choose to be an LLC or you can choose to be a PA. Before I go into detail about this, is anybody here an LLC? I know some of you are PAs, some of you may be LLCs. Anybody, nothing at all?
I'm nothing at all right now.
Okay, so
you're someone. Come on.
You're a realtor. You're just not. There's no business structure.
I'm not an LLC or a PA.
Okay.
Yeah.
Okay.
Julie, do you have your LLC or PA?
Not yet.
Not yet. Okay.
Okay. So let's sort of explain. An LLC is a limited liability company. It's created at the state level. In this particular case, it'll be the state of Florida. A PA is a professional association, and all that means it's a corporation. Some states call it professional corporation. Florida calls it professional association. The PA is also created at the state level. Both give you limited liability or corporate veil of protection, which is really important, especially as a realtor in your field. Let's say you're going out and you are selling a house, and the home buyer finds out that, there was black mold or there was something else with an issue with the house, and they turn around and they believe that you didn't disclose it, and they try to go after you for a lawsuit per se. Having a PA or an LLC protects your personal assets. You are actually operating as that entity. In fact, your license is no longer held by you as an individual. It's held by either your LLC or your PA. So you're really separating yourself from your business, which is very valuable. And that's really the legality point of it. So it really provides you with that, we'll say, I like separating between your business and your personal assets. It gives you the ability to protect yourself. Period. End of story. That's the state side. And people get confused between the state side and then the federal tax side. So let's talk about that for a second. A PA is a professional association. What that means is it's designated as what they call a corporation. All corporations start out as something called a C Corp. C corporations are great if you are Disney or Exxon or Amazon or any large company that is either A, planning on going or is going public, B, has more than 100 shareholders, and also wants to raise money. Now, if you're not one of them, which realtors generally are not, nor is an accounting firm like myself, the better structure would be something called an S corporation. S just stands for small business. That's what it is. With S corporations, the limitations are: one, you can't have more than 100 shareholders, which in your case, you have to have one. So that's only a problem. And you can't go public, things of that nature, which generally that's not what you're trying to do as an S corp owner. The benefit of an S corporation is that you're not subject to something called double taxation. So if you're a C corporation, you get taxed at the corporate level on the profits. And then when you pull the money out of the corporation to yourself as a dividend, you get taxed again at your personal tax rate based on your tax brackets, things of that nature. We want to avoid that. We want to avoid double taxation. So we elect something called an S corporation structure. S corporations are unique. They're unique in the fact that they have the ability to pass through your income or your loss from your business to your personal tax return. So in other words, when you file an S corporation tax return, which you do have to file a separate tax return for your corporation, it's strictly for informational purposes only. There's no tax, no federal tax levied on an S corporation. So let's say you have an income of $150,000 in commissions, and all your expenses are $100,000, including, let's say, some salary you decide to take. Your profit's $50,000. That $50,000 is now reported from your S corporation to your personal tax return on something called a K-1, which just shows, oh, I'm the 100% owner of the company. Here's the profit. And I report that on my personal tax return, and I pay it at my personal rate. Okay, there's no corporate taxes. Now I'm going to sidetrack and go backwards for a second. If you're an independent contractor, meaning you're not an LLC, you're not a PA, and you're having your 1099 paid to your social security number directly, you lose the limited liability or the corporate veil, so you don't have any liability protection. The other problem is you're also subject to two separate tax structures. One is your regular federal income tax, and two, all your profit is subject to something called self-employment tax. Anybody hear of that? Anybody familiar with self-employment tax? If you're not yet, you will be as you make more money. Self-employment tax is Social Security, Medicare, and the hopes that it'll be there and it'll continue to grow, which I don't really see how it's possible, but that's irrelevant. You're paying 15.3% on your profit. That's before any federal taxes. So let's say you earn $150,000 again in commissions, and your expenses are $50,000. That's your advertising, your dues, your auto, so forth, so on. I'm just using that as a round number, so we show $100,000. You're paying 15%, $15,000 roughly, in self-employment tax before you even start paying a dime in federal. And the reason you're paying self-employment tax is because you're self-employed. Now, when you are an S corporation, you're no longer considered self-employed. You're actually considered an employee of your corporation. Now, the IRS is aware of this tax loophole. So it is not something that's new to anybody. However, you have to follow their guidelines and follow their regulations. One of the things you do is, as an employee of an S corporation, which could be a PA, or an LLC taxed as an S corporation. I'll get to the LLC after. But as an employee, you're required to take what they call reasonable compensation. Now, here's where S corporations get a little more complex, and it's not something I would normally recommend an individual do on their own. When I say reasonable compensation, that doesn't mean you can write yourself a check and say, okay, I have my salary. It doesn't work that way. You have to actually pay payroll tax. You have to pay, and you have to file a payroll tax return, meaning a 941. The 941 is saying, hey, I'm taking X amount of salary each quarter or each month, whatever the case may be. Each quarter, a return is filed, and you're paying payroll tax on that salary portion that you take. So you're not getting away scot-free, but you are getting away with less than what self-employment tax would be. So let me sort of explain, and then we'll start taking questions and we'll go from there. If, let's say we're back at the same level, you're having $150,000 in commissions and your expenses are 50, okay? You have a profit of 100. Now, normally you pay self-employment tax on $100,000. But as a PA or LLC taxed as an S corp, what we're going to say is, hey, let's take a salary of roughly 40. In other words, we want to take reasonable compensation. We're going to pay that 15% tax. Now it's no longer considered self-employment tax, it's considered payroll tax because you're no longer self-employed. We're paying that 15% on the 40, which is $6,000. That's a lot different than paying the 15% on the 100, which you would if you're self-employed. So right there, you're saving roughly about 8 to 9 grand, $8,000, $9,000 just by structuring your business properly. Now, that's one piece, one of the very beginning pieces of the puzzle of saving money. You have the ability to choose your structure. That's part of tax planning. Now, an LLC or a limited liability company, again, is another state entity, does provide you liability protection, but it's more of a chameleon. And what I mean by that is when you first create an LLC and you're a single member owner, which all realtors in the state of Florida have to be. Some states are different, but in Florida, your license is held by an individual, one person. So if you are an LLC and you do not elect any tax structure, you're considered a disregarded entity. Now, what does that mean? That means the IRS knows you're an LLC, but because you're a single member LLC, they don't treat you any other way as if you, same thing as if you're an independent contractor. Now, from a liability point of view, you still have the benefit of liability protection because you have an LLC and that's how you're operating. But from a tax point of view, you're still paying the same self-employment tax. Now, here's where we have to be smart about things. When you open up an S corporation, you are required to file payroll tax returns. You're required to file a separate S corporation tax return. It's called an 1120S. There's more work involved. Okay. Being that there's more work involved, it takes a little more time to do, and it's a little more expensive than if you just filed as a Schedule C. However, if the savings are there, meaning that you're netting 25,000 or more, and this is not an opinion, this is a fact, unless you're dealing with an accountant that's trying to really rape you. If you're netting $25,000, think of it this way: $25,000 at 15% is roughly, let's call it $3,250. That's how much you're paying in self-employment tax. If you're making that same $25,000 net and you were an S corporation, let's say you take a salary of $10,000, you're paying $1,500 in tax. So you're saving about $1,700. The difference in the cost of filing the S corporate tax return and running all the payroll is still less than $1,700 versus, what you'd be doing if you just filed a Schedule C. So that's where really that number belongs. That if you're netting more than $25,000, netting is income minus expenses. You really should be an S corp. Whether you're an LLC taxed as an S corp or a PA taxed as an S corp, doesn't really matter. They're actually the exact same thing, other than the name. Now, for many new agents who have not started earning money or not earning net income of $25,000 or more, what I generally tell people to do is start with an LLC, and then you can actually turn the S corporation election on as you start making money. The problem is a lot of people will not create the LLC because they don't believe they're making enough money. And then the year ends, and then they realize, oh, I made, $35,000 in profit. I need to be an S corporation. And exactly what Sean said, at that point, when they come to me, I'm like, I can't help you because you don't have anything I can turn it into an S corporation. If you had the LLC, even if you did not elect S corporation status, I can retroactively elect it and say, hey, if you want to be taxed as an S corp under IRC 213-30, it's an Internal Revenue Service code. Can't do that if the LLC is not there. So that's the flexibility, and that's where planning comes into play. So a lot of people are like, should I be a PA or an LLC? And my answer is that depends. If you're making $25,000 net or more already, you might as well just be a PA because you're going to tell you to elect the S corp status already. If you're not quite there yet, but you plan on being there, you start with the LLC. And then once you elect the S corporation status, it's the same thing as having a PA anyway. It's just the different letters behind your name, but you are an S corp under the IRS guidelines. You're getting all the tax benefits anyway. But the benefit of the LLC is if you're not making that kind of money yet, then you don't need to pay for a separate S corporation tax return, things of that nature until you get there. Does that make sense? I'm going to stop for a second and see what questions, if we have any. Okay.
I do.
That's
I have
Judy.
one. I have one. What does PA
Sure.
stand for again?
Physician's assistant.
I know.
Yeah, you could be a physician's assistant, you could be a practicing attorney, but you're really just actually a professional association,
Okay.
which stands for professional corporation. An LLC taxed as an S corp has the same exact tax benefits as a PA taxed as an S corp. The IRS doesn't even look to see if you're a PA or an LLC. All they want to know is, are you an S corp or not?
Yeah.
From a liability standpoint, the PA provides a corporate veil. The LLC provides limited liability protection, same thing. It's just letters behind your name. Those letters can be very valuable in tax savings. So when we talk about tax planning, the first initial thing we talk about is choosing the correct business structure. Now, if you're not making any money yet, I don't really see any benefit in opening a PA and having to start filing S corporation taxes and paying more to do that if you're not making money anyway. So an LLC would make more sense. But as you start making more money, I could say, hey, now, because the LLC is in place, let's elect that S corporation structure and do what you got to do. Does that make sense? If the LLC is not there, I can't even do that. My hands are tied.
I have a question.
Yeah.
Sorry. If you have two different businesses, like you have real estate and then you have staging too, do you have to have two separate LLCs if they kind of have to do with real
Yeah.
estate?
So, every state is different. DVPR in the state of Florida and FREC is really strict. Because the license of your real estate business is actually held by your LLC or your PA, you have to keep them separate.
Okay.
Anytime you're getting paid via commissions, that's a separate business, and that would be strictly actually linked to your DVPR. In other words, when you create an LLC or a PA, we're registering your license with DVPR as an LLC or PA. You're no longer actually individually licensed, your company is.
Mhm.
Does that make sense?
Yeah.
So you do want to keep them separate. Now, granted, one can be a subcontractor of the other. I have clients where they have staging businesses, and the real estate company will actually pay the staging business to go out and stage the property and so forth and so on, which in turn, you're really giving me money from Peter to pay Paul, which I know is a pain in the ass record keeping wise, but that's the only way we have to do it. So in other words, you're taking money from your real estate business, you're hiring your staging company, you're paying them to stage a property that you're in turn want to show and sell.
Right.
So, in essence, you're paying yourself, even though it's going to a different company. That's the way it really is supposed to be done. Because it's not under the guidelines of FREC or DVPR. Does that make sense?
Kind of.
Now, if we get in, I know it's a pain in the ass, sorry about that. It's not my rules. If we get into real tax planning, as you're starting to make more and more money, the first piece, tax planning, is definitely your business structure. Now, if we get into situations where, I'm making, 100,000 net, I'm making 150,000 net, we're going to start talking about methodologies of what we can do to reduce taxes. In other words, I've had people who've come to me, they're making, 100 plus net income, 150,000 net income. And we may discuss purchasing a vehicle, which they're going to use for business. And I'm going to be able to depreciate a large portion of that. And that has the ability to dollar for dollar reduce the amount of income you're earning. So
How about a boat?
I've had clients who purchased a Chevy Tahoe for $65,000 and have written off $65,000 of income. Okay. That's under something called bonus depreciation, which was just extended actually. But the true and the real benefit of tax planning, because there's a lot of pieces to it. There's paying your minor kids if you have minor kids. There's something called the Augusta rule, which is renting out your house to your business, which is another thing that we can do. And then, of course, you have retirement planning, which is putting money into solo 401ks or SEP IRAs, things of that nature. But as you start making more money, I have some clients who are doing 500 plus. Now we're really starting into purchasing real estate, because as a real estate professional, you have one of the best tax planning strategies available to you more than anybody else in the nation. And I always tell people this: there's a reason Donald Trump doesn't pay taxes. Leave it as that. He's in the business of real estate. So because he's considered a real estate professional, meaning that he spends 750 hours or more in the business of real estate, all his losses in real estate are considered active. What does that mean? That means that, let's say he rents out a property. Now, granted, let's forget Donald Trump. Let's talk about us. You buy a property. Let's say you buy a $500,000 home that you rent out. Okay. And let's say you're getting in $50,000 a year in income. And then you have your mortgage interest, your property taxes, your insurance. And let's say you're breaking even or you're making a little bit of money. Great. Now you have this phantom expense called depreciation. Are you guys familiar with depreciation at all? Depreciation, you know what that means? I mean, if you look up the Webster's dictionary, depreciation means reduction of value. But the weird thing is, real estate historically doesn't go down in value. It's not like a vehicle or a piece of machinery or a tool. Generally, real estate has historically gone up in value. Yet, Congress decided it would be a good idea, mainly for the very wealthy. That's how this came to be, to allow people to depreciate a property. Now, normally for residential property, you depreciate over 27 and a half years. For commercials, it's over 39 years, but that's irrelevant. You don't need to memorize. You don't need to memorize that. Think of it this way: you have a $500,000 property, and let's say the land is worth 50 grand. Make it easy. So we're taking $450,000, dividing that by 27 and a half, and depreciating. Let's say that's $20,000 a year. That's $20,000. If you're breaking even between your interest and your property taxes and insurance versus your rental income, you're breaking even. That $20,000 phantom loss, because it's not really real. You're not really actually spending money on depreciation. It's just something you're allowed to use because you're a real estate professional. That $20,000 is now being used against income you've earned. Now, if you've earned $100,000 and you're writing off $20,000, that's real money. Probably going to save about $6,000, $7,000. Okay, and for an expense you never incurred. When I really get creative, and this is where we have to be really, really on the ball, okay, is as you start making more money, you're into the 3s, the 4s, the 5s. What's going to happen is your tax rate, because of tax brackets, because it's a progressive tax, goes up. People who are making $400,000 or $500,000, part of their income is 30% or higher. That's where we use a tax planning strategy called cost segregation. I don't know if you're familiar with it, if you ever heard of it. And now I'm getting into really advanced tax planning stuff. I'm sorry. I just want you to know it's out there. What cost segregation means is it's another, what's called an IRS allowable strategy, which allows you to take pieces of the house or the condo, whatever the case may be, and assign them different lifespans. So, the flooring is, instead of a 27 and a half year, it's 15. Cabinets are 14 or 12. Maybe you have window coverings, things of that. And they're going to, based on the IRS guidelines, they're going to allow you to depreciate certain pieces of the property at a faster rate. Now, what does that mean and why is that important? Well, for one, in 2017, the IRS passed something called bonus depreciation. And what that means is any property that is 15 years or less lifespan in a property, in a house or condo, you depreciate 100% of it. So generally a good rule of thumb is roughly 15% of the value of the property. And again, it's not exact, but I've done enough cost segregation studies to know that's about the average. So if you have a property, you bought for $500,000, and let's say it's a condo, so there's no land value. It's $500,000. I'm very confident that we can depreciate $75,000 to $80,000 year one. That's huge. If you're making $500,000 or $400,000 and you're in a 30% bracket, and I'm knocking off $80,000 in income, you're putting $25,000 in your pocket just by running a cost segregation study, just by having rental property. So I do have some realtors who are buying 2 properties a year because that's how much they're making. So they're actually going out and buying 2 properties a year at $500,000 a pop or more, and cost segregating them and reducing their taxes significantly. And now someone else is paying their mortgage off. And the beauty of this is, as the houses appreciate over time, it may not happen. I mean, sometimes it goes down in value, but over time, properties will go up in value because there's not enough properties to substantiate the number of people. So what's happening is people will do something called a 1031 exchange. You guys familiar with 1031 exchange?
Yes.
All a 1031 exchange means is that we've reduced the value of the property from depreciation, but the value is worth more than when we first purchased it. So what we're going to do is, instead of selling it and paying a capital gain on it, we're actually going to identify a different property and take the money from the sale of the property you're selling and using it to buy a different property. Often you're buying a property that's worth more money because the cost of the property you're selling is higher than when you initially bought it 5, 6, 7 years ago. Okay, so you're going to take this 1031 exchange and buy a higher value property, which gives you the ability to depreciate it again. Or you could buy 2 properties. I've seen people buy a house for $400,000, 7 years later, sell for $900,000 and buy 2 properties at $450,000. It's certainly, or more. I mean, that's fine. You can still get a mortgage and do whatever you want to do. And what you're doing is you're kicking the proverbial can down the road. And here's where the most important piece of this puzzle is. Because when you do solo 401ks, when you do IRAs, they're great because you're getting tax deferred benefits now for retirement. But eventually you're required to take that money out. The IRS requires you to take that money out and pay tax on it. And even if you die and your beneficiaries get that money, they're going to pay tax on it. Not true with 1031 exchange. I can depreciate these properties over time down to 0, which means I've already taken advantage. I squeezed out all the benefits of them and I've written off against my taxes. And I do a 1031 exchange. And I depreciate that property again, by higher cost basis. And I keep doing that when I buy new properties and so forth and so on. You may have at the end of 20 years, $8 million in assets of properties with a cost basis of $500,000 because you depreciated them all. Which means you saved $7.5 million against your income over a lifetime, which is a lot. And now, as Benjamin Franklin said, there's 2 things guaranteed, right? You're going to have pay taxes and you're going to die. Now, unless you can figure out the second part and not die, which good luck to you, eventually that's going to happen. So what's going to happen is you're going to die. I'm not trying to be morbid. But what happens is when you leave these properties, these fully depreciated properties, to a beneficiary that's not your spouse. So it's got to be your child or your sister or your niece or your nephew. What's going to happen is they receive these properties at what they call a step-up basis. And here's the magic. This is where generational wealth is made. Has anybody heard of the step-up basis? Step-up basis means when someone inherits a property, inherits a property, they receive it at the value of that property on the day of the inheritor or the inheritee, the person who dies, the day of their death. So let's say you have properties that are worth, in total $8 million. Cost basis is only $1 million because you depreciated $7 million over 20 years. They get those properties and all the depreciation is forgiven. It's like it never happened. And now they're getting it at $7 million. They can turn around and sell that property and pay zero tax. That's unbelievable. That's the golden goose.
No capital gains if they turn around and sell it. Wow.
Nothing. That's the cost base. That's the step up basis.
Right.
Now it can be done with stocks and things like that too. The problem is you can't depreciate stocks, so you're just holding on to them. Whereas you can actually take this real estate, depreciate it right off your expenses, right off your income from this phantom depreciation, which doesn't exist, right? You're not actually paying money in your pocket for depreciation. It's just using an IRS code. That's how the wealthy keep their money, and that's how the wealthy are pushing money to their children.
David?
Obviously, if you make more than 12 million or so, then we have to worry about estate taxes. And then that's where you get into life insurance planning and things like that, which we'll talk about separately.
I have a quick question regarding that. So if you have an LLC as a real estate agent and you buy property, should you put the property under that LLC or a separate LLC?
No. So the LLC for the real estate agent always strictly deals with your real estate commissions and real estate business. That's it.
And that's it. Okay.
So in other words, I own 6 properties myself.
Mm-hmm.
They're all short-term rentals, which is another conversation we have to have. But because I'm not in the business of real estate, if I owned long-term rentals, I don't get the benefit of using active expenses, which means even if I show depreciation, I have a loss, I can't use against my income. But short-term rentals, you can. So this is a really good thing for you guys if you ever try to sell investment properties to people who are not real estate investors. You get them into the short-term rental world, because short-term rentals are not considered long-term real estate. They're considered hotels. It's considered a separate business model, incomplete. And they have the ability to actually take advantage of the depreciation like a real estate professional would. But to answer your question, each property I own is owned in its own LLC.
Okay.
And normally what I do is I have an LLC for each property.
Mm-hmm.
And then I have a holding company which owns each LLC.
Okay.
So how I do it is, let's say I have a property in Asheville, which is true, in Asheville, North Carolina. And the property is called Timberwood 123, which is the name of the street. So it's Timberwood 123 LLC, owned by Byck Family Holdings. And then I have a property, let's say in Georgia, and it's called Georgia 123 LLC, owned by Byck Family Holdings. So each LLC is separate,
Mhm.
and they all roll up into a holding company.
Gotcha.
So,
If you want to be really creative, then you open up Wyoming or Nevada LLCs, which are anonymous. So those are things that we do as well. You don't do that for your real estate license. It's got to be in Florida. But if you're owning actual properties and you want to have anonymity, I hate that word because I can't pronounce it, anonymity, then you would use like a Wyoming LLC per se. And that's completely anonymous. So, and all that it does, it makes hard people to sue you.
Yeah.
And that's really asset protection.
Gotcha. So if you own a long rental versus the short-term rental, you can still use that depreciation.
Yeah. So for real estate professionals like yourselves, okay, you can buy long-term rentals all day. You can depreciate them. You can do cost segregation. And if you have a loss, which you will, especially if you do cost segregation, because you're speeding up your depreciation, your losses you could use against any other ordinary income you earn. So if you have $500,000 or $200,000 of income from selling real estate, or let's say your spouse is on W-2 and makes $200,000, okay, and now you have this property and you're depreciating it, even though it's a long-term rental, because one of you, meaning you, one of you in the spousal team is considered a real estate professional, you can use that loss against outside income and reduce your taxes. However, let's say your client's a doctor and his wife is a lawyer, whatever, or vice versa. Doesn't really matter. Neither of them are considered to be in the business of real estate. To be in the business of real estate, you have to earn more than 50% of your income from a real estate type business, which means you either have to be a builder or you have to be a real estate professional, something like that. It's not a mortgage broker. It doesn't count. It's got to be actually in the business of real estate. Now, more importantly, you have to also have at least 750 hours a year in the business of real estate, and 50% or more of your income has to be in the business of real estate. Now, as long as one spouse can do that, then they qualify and they could use the losses as active. But chances are, people you're selling real estate to are not realtors. Otherwise, they probably won't be going to you. They would do it themselves. So in that particular case, if neither one is in the business of real estate, neither spouse, it's not going to be able to work unless they use a short-term rental loophole. The short-term rental loophole says you don't have to be in the business of real estate. You just have to spend at least 100 hours or more involving the short-term rental. So like what I do is I'll go up to, let's say, my property in Asheville, and I'll spend 4 days there painting, doing this, that. I mean, right there, I'm spending 90 hours, plus speaking to guests, things like that. Short-term rental is like a hotel. The rules are it's got to be an average of 7-day rentals or less. Think of the Airbnb world. So if you do come across clients that, are high net worth or high wage earning or high income earning people, and they do want to purchase investment properties, having them understand, and if you want me to speak to them, I'm happy to, having them understand the value of cost segregation and depreciation and having the ability to write off their income versus their expenses is tremendous. It's tremendous. I do have
So
some doctor
I'll
clients.
admit, David, that I didn't know that. Right.
Mm-hmm.
So if I were anyone on this call, I'd be making a social media post right now, talking about that, just enough to get them interested and engage in conversation, right? How can you, as a non-real estate professional, invest in real estate and have the same tax benefits as a real estate professional?
Yep, and the rule is it's got to be considered a short-term rental.
Yeah, we don't tell them that. They got to call.
Yeah, exactly. You just want to get them in. You want to get them to call. Otherwise, they're considered passive investors, which sucks because that means, let's say, you have a $40,000 loss from depreciation, it goes bye-bye. You don't get to use it, which is, that defeats the whole point of, unless, of course, they have a lot of passive income. Meaning, let's say they have income from, interest or dividends, things like that, they can use it against, but not actually earned income. Not from W-2s, not if they own their own business, things like that. Just where the majority of their money is coming from.
Right. And I'll say, just from experience, it seems, we're in this business and this is still somewhat fresh to us, these tax strategies. So if it's fresh to us, that it's completely alien to other professionals that are,
100%.
Right. So I think, to me, like, that's part of our duty, is to spread the word and get people, they say, like, how can I get real estate investors? How can I get customers to be, interested in buying real estate? Right there, prime example.
No, huge. Another thing that people often do, I hate saying that, is, they take advantage of the primary residence exclusion, where people will go buy a property that needs work. They live in that property, stay there for 2 or 3 years, and they sell it. And a lot of times they can get those capital gains now tax-free. As long as they live in that property as a primary for 2 years, I buy a fixer-upper, and this is if you're handy or, if you know what you're doing. But if you have clients like that, I have, certain clients who will buy a property, sit in it for 2 or 3 years, fix it up because they're very handy what they do. They make $300,000 on it. They sell it, and there's no capital gains because they're married and they've owned the property for 2 years and they have a $500,000 exclusion. So it's like tax-free income.
Yeah, plus the homestead exemption, which isn't, a lot, but it still helps.
Yeah, and that's portable. So you can port the homestead exemption to every new property. So,
Yeah.
yeah, I mean, that's something that people do as well. But if you really want to get into finding investors that can really save them money, you become a short-term rental expert. Because that's what people don't know. And it's so new. I know Airbnb's been around for, let's say, 8-10 years. But in the scheme of things, that's very new. And once you get involved in tax strategies, you want to find a niche. That's a niche. So something we are putting together, which is going to be happening hopefully next year. We're going to start doing classes, and we're creating a designation called an STRS, which stands for short-term rental specialist. And we're going to teach people how to actually find these properties, and more importantly, how to value them. Because it's one thing to actually find them, and you can find a million properties that are great, and then you find out, oh, I can't do it here. I'm not allowed to do it here. Because a lot of them have code issues. And then if you do find one that works, because you're allowed to do it, or the numbers work. And that goes into understanding the numbers. We have formulas we use and everything else. But that's something that we're going to be working with, hopefully Berkshire and a bunch of other companies to do that. So
Awesome.
Awesome.
I just have a quick question, David. So, and I can call you later, but when we're talking about homes, and I haven't decided, my situation. So like with the first house in Dunedin, like, do you suggest then that I would put that in a LLC if I decide to keep it and rent it? Because I'm still going back and forth. Or should I do it?
If you're renting a property, remember, so you can only have one homestead. Okay.
Right.
So
And I'm about
if
to
you're
file
renting a
it on the
property,
condo.
right, if you're renting a property, you always want to have that property in LLC. It protects it. Period. End of story. Because especially, look, if you're mortgaged to the hilt and someone's going to try to sue you and take your property and they can't because the mortgage is there first, okay, maybe. But you want to separate that property from your personal assets. So if you have renters in there or you have short-term renters in there, granted, of course, you have insurance, but the insurance is only as good as the insurance company. So having an extra layer of protection, like an LLC, is huge. It separates you from a different business.
So will that help me if I just? Would that help me if I decided to sell it? Still?
No, again, not necessarily, because an LLC is going to show the same capital gains, things of that nature. Now you're in a unique position because you've lived in it 2 of the past 5 years. So if you sold it, a year or 2 from now, and we could say, well, I've lived in it 2 of the past 5 years, that's a primary exclusion. So, we may be able to reduce, a significant amount of capital gains, if not all.
We want that. We definitely want that.
Yep, that's a good thing.
I'll call you later because I need to figure it out soon.
Okay. But dealing with LLCs, you should always have every property that's a rental in an LLC.
Can you LLC a rental property if you have a mortgage on it though?
Yeah, look, at the end of the day, there's something called the acceleration clause, where mortgage companies will say, oh, if you change the name, you need to do. I'm telling you right now, I've done it for 20 years. I've never seen an acceleration clause accelerated. The mortgage company is in the business to make sure you're paying.
Right.
So as long as you're paying your mortgage, they can give a rat's ass. What you normally would do is you're going to close your business and unless you're buying a commercial property, which is a completely different animal. Like if you're buying a hotel or an 8-plex or something like that, then it's different. But if you're buying a residential property, you're going to close in your name and you do a quitclaim deed into the LLC.
Right.
After the fact.
Even if, so if you're still
the mortgage is still guaranteed by you personally, you're still responsible for the loan. That I can't help you with unless you're getting a non-recourse loan. And that is usually something called a DSCR loan or something like that, where it's non-recourse and attached to the property itself. But even if it's a property that you're guaranteed a loan on, that loan's guaranteed regardless. What you're protecting yourself is if someone tries to sue you from when they're at your property and they're renting it. Or someone tries to sue you because let's say you're driving a car down the road and you kill someone, and now they're trying to get your asset. That's a separate asset from you. Because it's an LLC, it's under a separate, especially if you own it with a spouse or a friend or whatever.
Mhm.
They can't touch it.
Okay.
And you can still quit claim even after 3 years go by.
You can quit claim it, I would say 2 weeks after you close.
Well, I'm saying now, I could quit claim the Dunedin house to
Once you
an LLC.
remove the homestead from that property, you can do whatever you want with it.
Okay, that's the ticket.
You
Okay.
can't put it in an LLC. I strongly do not recommend ever putting a homesteaded property in an LLC. There's no
Gotcha.
point.
Right.
So can you
It should be a rental.
repeat what you said about the DSCR loan?
So DSCR loans, hard money loans, many of those type of loans are considered non-recourse. All non-recourse means is that the lender, their only guarantee is the house itself. There's no going after you personally.
Okay.
So, and that's more of a commercial type loan. It's not like a conventional Fannie Mae or Freddie Mac type loan where you're going to write, you're going to have a loan guarantee where you're going to say, hey, if this property, if I'm not paying the mortgage, then they're going to sue you. The most they can do is take the property. They can't go after you personally.
So
Yeah,
That's what
like
a non-recourse loan would do.
do you recommend
Usually
LLC?
those are higher rates, but some people do them, and that's fine.
So do you recommend LLCing a home that's a rental property under a DSCR loan?
Well, yeah, because again, remember, the loan type is strictly the way you buy the property. The
Mhm.
property is an asset. So I got a DSCR loan, and 3 years later, the property is worth a lot of money, way more than my mortgage. So I'm going to protect that asset. So if I'm sued personally, they can't go after my LLC.
Gotcha.
I'm protecting that asset. That's the point.
Okay.
And also, if someone tries to sue that LLC because they're living there, whatever, they can't go after my personal assets.
Okay.
Does that
Thank
make
you.
sense? You're trying to separate that.
Mm-hmm.
Yeah, so
Thank you.
just
So-
any of these LLCs are just for properties that are not your primary residence.
Yeah, primary residence in Florida, there's no benefit because homestead is a rock
Yeah.
solid.
Got it.
Yeah, the only
Should
way
you-
you're being penetrated with the homestead is a federal agency with 3 letters. The IRS will take your house. They don't care about homestead.
Should you be
Don't
putting
play with that.
vehicles, oh, sorry, should you be putting vehicles and such in LLCs too, or is that like, do
mean,
you have a
vehicles-
trust?
Vehicles tend to depreciate over time as opposed to appreciate. So, and the other problem with putting a vehicle in an LLC is usually you have the commercial insurance, which may be more expensive. Now, if you're
Okay.
using a vehicle as like, a ride share or something like that, that's something you may want to look at. But just for a personal vehicle, I don't see any benefit.
And just
Mainly
to
because
point
of
out real quick,
depreciating asset. Unless you're on some like, crazy car or something like that, is going up in value, which is possible, I guess.
yeah, Toyota Tacomas go up in value.
There you go.
Going back to the DSCR loans or the non-recourse loans, just so everyone's aware, Tom and Barbara at Preferred Lending Services have that as a part of their Smart Series, their portfolio loans that are essentially their money. It's not a Fannie Mae or Freddie Mac product. So that is something that's available. The DSCR debt service cover ratio. So if you've heard Tom
Mhm.
talk about that, essentially if the rental income is $1 more than what the mortgage payment is, it qualifies. So
Yeah, and that's a separate type of loan. Like it's not conventional, like you said. It's a different type of structure, period.
right.
So, and those a lot of times you can close an LLC, if they allow you to.
Right.
So, but feel free to call me anytime. Sean has my number and my email. Happy to help you out on anything you need.
Would creating with these LLCs, we would just go to Sunbiz sunbiz.org, or do we?
It depends on the LLC you're doing. If you're doing an LLC for your real estate business, yeah.
Yes. Okay.
If you're doing an LLC for a property,
Mhm.
that's a little bit different. It depends where the property is located.
We could go through you to do that, or?
Yeah, I do it. I
Oh.
do it all day. Tax turns, LLCs, tax planning, all that fun stuff.
So if it's a business, go to sunbiz.org. If it's a property, basically, go to you.
Yeah, I mean, again, as you start buying properties, and again, a lot of it depends on where you're buying, right? So if you're buying a property in Florida, then I want a Florida LLC. But you may have that Florida LLC owned by a Wyoming company. For the main reason is at that point, they'd have no idea who the owner is, which makes it a lot harder for someone to sue you. That's the reason behind it. Not to say you have to do that, but that's what I would recommend, especially as you start buying more and more real estate. But when it comes to, for your real estate license, it's got to be a Florida. It's got to be where your license is held. And that's just the DVPR rule. That's nothing to do with me. If you're
Awesome. Well, I
making
put
30, 40,000 net or more, 25,000, 30,000 net or more, I would just go right for the PA. If you're brand new and you haven't started making any money yet, go with the LLC, and then we can always change it when needed. But not to have anything, I think you're asking for trouble. You need to have something in place so you have the flexibility. Because I've seen too many times where people come to me the year after and be like, "Oh, I need an S corp from last year." I'm like, "Do you have an LLC?" And they're like, "No." And I'm like, hands tied. I can't do anything. I mean, if I was, Marty McFly and I can go back in time, back to the future, I would. But other than that, I can't help you. So.
Yeah. I mean, again, just personal experience. I spent 4 years without an LLC or a PA, and thousands of dollars that were flushed down the drain. And I was just, once I met David and learned about this, I was like, man, why didn't they teach us this in real estate school? Right? It took me 4 or 5 years to figure this out, but okay.
Yeah,
So.
I mean, everyone's like, "Oh, speak to a tax professional." People don't want to do it because they don't know the laws. They don't want to get in trouble. So I get it. I understand. Yeah. But I'm happy to help.
Yeah, I put your contact info in the chat. So, and I'll send a copy of this video to everybody. And yeah,
cool.
Appreciate it as always, David. I know you're busy this time of the year.
All good. I got you.
Thank you.
Anything you need, give me a ring.
All right. Thank you, guys.
Thank you so much.
Bye, everybody.
Thank you.
Thank you. Bye, guys.